Picture a quiet evening in early 2026. You're sitting in a small apartment after work, scrolling through your banking app. Your salary is higher than it was a few years ago. In fact, you even received a raise recently. On paper, things should be better. Yet the numbers on the screen tell a different story. Somehow the account balance seems to shrink faster than it used to. You haven't started living extravagantly. You don't own luxury watches or sports cars. Your lifestyle is fairly ordinary. Rent, groceries, occasional takeout, a few online subscriptions, maybe coffee on the way to work. Nothing about it feels excessive. And yet, month after month, the leftover money at the end of the cycle is smaller than it used to be. For many people, this experience creates a strange kind of confusion. It doesn't feel like financial mismanagement because spending habits haven't changed dramatically. But the math quietly stops working. What once felt affordable now feels tighter. The explanation for this isn't simply inflation, and it isn't because individuals suddenly became reckless with money. Something deeper has changed in the architecture of modern consumer spending. Across the last 2 decades, companies have gradually redesigned how products and services are sold. The transformation was subtle but powerful. In earlier generations, most purchases followed a simple structure. You bought something once, paid for it, and owned it. A television, a kitchen appliance, a piece of furniture. The transaction ended after payment. Businesses earned revenue by creating new products people wanted to buy. Consumers spent money primarily when they needed something tangible. But beginning in the late 1990s and accelerating through the 2010s, corporations began studying how people actually behave when spending money. Behavioral economists discovered something important. People resist large payments, but they tolerate small recurring ones. If a cost is divided into smaller pieces and scattered across time, it becomes psychologically easier to accept. This insight reshaped entire industries. Instead of charging a large one-time price, companies started designing systems built around continuous micropayments. Monthly subscriptions replaced ownership. Convenience fees appeared in everyday transactions. Services began layering additional charges in ways that were difficult to notice individually. Each charge felt minor, but when combined across dozens of everyday activities, the effect on household budgets became enormous. The genius of this system is that it rarely feels painful in the moment. A $10 subscription here, a $5 service fee there, a delivery charge that seems small compared to the convenience it provides. None of these individual payments seem large enough to trigger resistance, but over time, they accumulate into thousands of dollars quietly flowing out of bank accounts. Data from economic studies shows that household spending has been rising faster than income for several years. That difference may look small annually, but it compounds gradually. When expenses grow faster than earnings for long enough, the gap eventually becomes impossible to ignore. What makes this trend particularly difficult to detect is that the spending feels normal. Ordering food through an app feels routine. Streaming shows online feels standard. Buying a new phone every few years feels expected. These behaviors are now embedded in everyday culture, which makes them invisible as financial decisions. But underneath that normal appearance lies a carefully engineered system designed to maximize revenue from ordinary life. Pricing structures are tested, refined, and optimized to extract the highest amount consumers are willing to pay without creating pushback. Companies analyze customer behavior constantly, adjusting fees and subscription models based on what people tolerate. The result is a modern economy where many everyday purchases cost far more than their underlying value. The difference between what something costs to provide and what consumers pay has widened dramatically in certain categories. Because the increases are fragmented across hundreds of small transactions, the overall impact often goes unnoticed. Understanding this shift requires looking closely at the everyday expenses people rarely question. When you break them down, a pattern begins to appear. Certain purchases that once made economic sense now function very differently. And once you see how these systems work, it becomes impossible to look at everyday spending the same way again. One of the clearest examples of how modern pricing quietly extracts money from everyday life is food delivery services. At first glance, these apps appear to solve a simple problem. After a long workday, cooking feels exhausting. Instead of preparing a meal, you open your phone, scroll through nearby restaurants, tap a few items, and within 30 minutes, dinner appears at your door. The convenience feels effortless, almost harmless. But the true cost of this convenience is rarely obvious. And when people look at the checkout screen on a delivery app, they usually assume they're paying the same restaurant prices plus a delivery fee. In reality, the pricing structure is much more complex. Many restaurants increase their menu prices specifically for delivery platforms. This happens because the platforms charge restaurants large commissions on every order. To compensate, restaurants quietly raise the listed prices inside the app. What customers see is not the restaurant's real menu price, but an inflated version designed to cover the platform's cut. Once the order reaches the payment screen, several additional costs appear. There may be a delivery charge, a service fee, and sometimes a small order fee if the total is below a certain amount. On top of that comes the tip, which customers are socially encouraged to add before the food even arrives. Individually, each of these charges seems minor. Together, they can transform a simple meal into something far more expensive than expected. Imagine ordering a meal that normally costs around $12 at the restaurant counter. By the time the delivery version is finalized, the same order might cost $20 or even $25. That difference isn't paying for better food. It's paying for the mechanism that transports the food. For people who occasionally use delivery apps, the extra cost may not seem significant. But the real impact appears when the behavior becomes routine. Many regular users place multiple delivery orders each week. If the hidden costs average $15 per order, and someone orders twice a week, and that convenience quietly consumes over $1,500 every year. And that money isn't buying additional food. It's paying the digital infrastructure that sits between the restaurant and the customer. What makes this system particularly effective is timing. The apps know exactly when people are most likely to order. Notifications often appear around dinner hours when people are tired, hungry, and mentally drained from the workday. Decision-making becomes weaker during those moments, making convenience far more appealing than cooking. The design of the platforms is not accidental. Every color, notification, and promotion is tested to increase the likelihood of placing an order. This dynamic reflects a broader pattern in modern consumer systems. Technology companies are not simply selling services, they are optimizing human behavior. The more predictable consumer habits become, the easier it is to design systems that convert those habits into revenue. Food delivery platforms illustrate this pattern perfectly. They provide a service people genuinely appreciate, but the pricing structure is built to maximize extraction from moments of fatigue and convenience. Over time, what feels like a harmless weekly habit turns into a steady stream of spending that most users never fully calculate. If this pattern seems familiar, it's because similar strategies appear in many other industries. Products and services that once involved straightforward purchases have gradually evolved into complex financial relationships. The consumer still believes they are buying something simple, but behind the scenes, the system has changed. And when you begin examining other common purchases through the same lens, you start to notice how many parts of daily life now operate in this exact way. Another place where the modern spending system quietly works against consumers is the automobile market. For decades, buying a new car has been presented as a milestone of financial progress. Advertisements show people driving away from dealerships smiling, proud of the shiny new vehicle in their driveway. The experience feels like an upgrade in life, but beneath the excitement lies a financial reality that many buyers underestimate. The moment a new car leaves the dealership lot, its value drops immediately. This isn't a small decline either. A significant portion of the vehicle's value disappears within the first year of ownership. What many buyers don't realize is that they are paying thousands of dollars for value that evaporates almost instantly. Historically, car depreciation has always existed, but the way vehicles are financed today makes the effect much more difficult to see. Instead of focusing on the total price of the car, buyers are usually guided toward a monthly payment number. Dealers structure the financing so the payment appears manageable. Loan terms have stretched longer and longer to accomplish this. 6-year and even 7-year loans have become common. At first glance, this seems helpful. A longer loan spreads the cost over more time, lowering the monthly payment. But this also creates a financial trap. During the early years of the loan, the borrower often owes more on the vehicle than the car is actually worth. This situation is known as being underwater on a loan. If something unexpected happens during that time, such as the car being totaled in an accident or the owner needing to sell it, the insurance payout or resale value may not cover the remaining loan balance. The difference must come directly out of the owner's pocket. Many people don't encounter this reality until they attempt to trade in or sell the car years later. At the same time, car prices themselves have climbed rapidly in recent years. Modern vehicles include advanced electronics, driver assist systems, and larger infotainment displays. While these features add convenience, they also increase the purchase price dramatically. What used to be a moderately priced vehicle now easily reaches tens of thousands of dollars. Manufacturers have also begun experimenting with a new model that pushes costs even further. Certain features inside the vehicle are no longer permanently included with the purchase. Instead, they can be activated through optional subscriptions. Some cars now offer features such as remote services, navigation updates, or additional software capabilities through monthly payments. In other words, the vehicle itself becomes a platform for continued charges even after the initial purchase. From a financial perspective, the economics of buying new have shifted significantly. A vehicle that is several years old has already absorbed the steepest portion of depreciation. The first owner effectively paid for that loss in value. The second buyer often receives a car that is still modern, reliable, and capable, but at a dramatically reduced cost. Modern engineering has also improved the durability of vehicles. Many cars now operate reliably for well over 100,000 miles when properly maintained. That means a slightly older car can still provide many years of transportation without the massive upfront depreciation. Yet, despite these facts, many buyers continue choosing new vehicles because the system encourages it. Advertising emphasizes the excitement of something brand new, and financing structures focus attention on monthly payments instead of total cost. Trade-in incentives make upgrading feel easier than continuing to drive an existing car. The entire structure nudges consumers toward repeating the purchase cycle more often than necessary. Just like the food delivery example, the car market doesn't operate this way by accident. Every part of the buying experience has been refined to make higher spending feel reasonable. The result is that transportation, something that should simply move a person from one place to another, becomes one of the largest ongoing expenses in many households. And once you start recognizing how these incentives shape spending decisions, it becomes easier to see the same pattern repeating in other everyday purchases. Another area where modern spending has quietly transformed is the way people pay for entertainment. 2 decades ago, watching television followed a relatively simple system. A household subscribed to cable or satellite service, paid one monthly bill, and gained access to a wide range of channels. It wasn't perfect, but the cost structure was straightforward. When streaming platforms first appeared, they promised something revolutionary: freedom from the expensive cable bundle. Consumers could cancel cable entirely and instead subscribe to only the services they truly wanted. The idea sounded like a financial improvement. Pay less, watch what you love, and ignore the rest. For a brief period, that promise actually worked. Early streaming services offered large libraries of content for relatively low monthly prices. Many households discovered they could replace cable with 1 or 2 streaming platforms and save money each month. The shift felt like a win for consumers. But the entertainment industry adapted quickly. Instead of a single cable bundle, companies began separating their content libraries into individual streaming platforms. Studios launched their own services to control distribution. Each platform held exclusive shows and movies that could not be found elsewhere. If someone wanted access to a wide variety of entertainment, subscribing to just one platform was no longer enough. Gradually, households began stacking subscriptions. First, it might be one service, then another platform releases a show everyone is talking about. Soon, there are 3 or 4 active subscriptions. Each one costs around $10 or $15 per month, which doesn't feel overwhelming individually. But when several of them accumulate together, the total monthly bill quietly grows. Many people don't even notice when this happens because the payments are automatic. Once a subscription is activated, it renews every month without requiring further action. The charge appears on a credit card statement along with dozens of other small transactions, making it easy to overlook. This is where an important psychological principle comes into play. Researchers studying consumer behavior have discovered something known as the subscription effect. When payments are broken into predictable monthly charges, people tend to think less about the total cost over time. A service that costs $15 per month feels small, even though it adds up to $180 over a year. Now multiply that by several streaming services running at the same time. Suddenly, entertainment that once seemed inexpensive begins approaching the cost of the cable systems people originally tried to escape. The difference is that the new system hides the total more effectively because each charge is separated. Another factor keeps people from canceling unused subscriptions: friction. Canceling a service often requires navigating account menus, confirmation pages, and retention offers. The process may only take a few minutes, but it still requires attention and effort. Many users postpone the task, telling themselves they will cancel later. Meanwhile, the monthly charges continue. Studies have shown that a significant percentage of subscribers keep paying for services they barely use, not because they love the platform, but because canceling never becomes urgent enough to complete. This strategy has existed long before streaming. Magazine companies used automatic renewals decades ago because they discovered readers often forgot to cancel subscriptions they no longer needed. The modern streaming industry has simply refined this strategy with digital billing systems and frictionless payments. None of this means streaming services are inherently bad. They provide real entertainment value and have changed how media is consumed. But the financial structure surrounding them encourages accumulation rather than selective use. A more rational approach would be rotating subscriptions, joining one platform, watching the content that interests you, then canceling before moving to another service. The content libraries rarely disappear overnight. Yet doing this requires deliberate attention, and attention is exactly what modern subscription systems quietly try to exhaust. What began as a cheaper alternative to cable has slowly transformed into a new kind of bundle, one where the total cost remains hidden behind many small charges. And when those charges are combined with other everyday expenses, they form another piece of the larger puzzle explaining why so many people feel financially squeezed despite earning more than they used to. Another category where the economics have shifted dramatically is fast food. For decades, Fast food chains served a very specific purpose in the economy. They were not known for gourmet quality or exceptional nutrition, but they were affordable. Workers, students, and families with limited time could rely on fast food as a quick and inexpensive meal option. A few dollars could buy something filling enough to get through the day. Convenience and low cost were the entire value proposition. That equation has changed significantly in recent years. Prices at major fast food chains have increased much faster than many people realize. A meal that once cost $5 or $6 now frequently costs double that amount or more. Combo meals that include a sandwich, fries, and a drink often land somewhere between $10 and $15 depending on the location. In some cities, the price climbs even higher. At first glance, it may seem like ordinary inflation, but the shift goes deeper than that. And when fast food begins approaching the cost of casual dining restaurants, the original advantage of the category disappears. Consumers are no longer paying extremely low prices for speed. Instead, they are paying near restaurant prices for food designed around efficiency and mass production. The experience itself hasn't changed much. People are still eating quickly, often inside their car or at a small table under fluorescent lighting. The meal is still prepared in seconds using standardized ingredients designed to be inexpensive at scale. But the prices move closer to what people would expect to pay at establishments offering higher quality ingredients, larger portions, and a more comfortable environment. This shift reflects several pressures happening simultaneously across the industry. Labor costs have increased as minimum wages rise in many regions. Commercial real estate prices for high traffic locations have climbed. Supply chains for ingredients have faced disruptions and price fluctuations. All of these factors raise operating costs for restaurants. But there is another important reason prices have continued climbing. Consumers kept buying. Businesses rarely price their products based only on what they cost to produce. Instead, they charge what customers are willing to pay. When customers continue purchasing, even as prices rise, companies interpret that behavior as proof that higher prices are sustainable. The result is that fast food has gradually repositioned itself from a cheap emergency option into a convenience-driven habit purchase. Consider the long-term math of that habit. If someone buys a fast food meal 3 times each week, and each visit averages around $12, that spending adds up to nearly $2,000 over the course of a year. That is a substantial amount of money spent on meals that are consumed quickly and forgotten just as quickly. The comparison becomes even more striking when those costs are compared to preparing food at home. Basic ingredients for a simple meal often cost only a fraction of the price of a fast food combo. With a bit of planning, the same money could stretch much further while also providing better nutritional value. Of course, cooking takes time and modern schedules often feel overloaded. That time pressure is exactly why convenience industries continue growing. When people are tired, busy, or overwhelmed, quick options become extremely appealing. Fast food chains understand this psychology very well. Their marketing focuses heavily on speed, accessibility, and habit. Bright signs, mobile ordering apps, and drive-through lanes are all designed to remove friction from the purchasing decision. The more effortless the purchase feels, the less likely people are to reconsider the value of what they're buying. Just like the delivery platforms and subscription services discussed earlier, fast food pricing illustrates how modern spending systems take advantage of convenience. The purchase feels small and routine, but repeated frequently enough, it becomes a meaningful drain on household finances. And when those small, routine expenses are combined with several other categories operating under similar pricing strategies, the cumulative effect begins to reveal why so many people feel like their income stretches less each year. The final example may seem small compared to cars, travel, or subscriptions, yet it illustrates the entire system of modern spending more clearly than almost anything else: daily premium coffee. On the surface, buying coffee from a cafe feels harmless. It's a routine many people enjoy. You stop on the way to work, order your usual drink, exchange a quick greeting with the barista, and continue your day. The purchase feels like a tiny reward, a brief moment of comfort before the responsibilities of the day begin. Because the cost is relatively small, most people never question it. But when that small habit repeats frequently, the numbers tell a different story. A specialty coffee drink at many cafes now costs around $5 or $6. For someone who buys coffee on the way to work every weekday, that amounts to roughly $30 each week. Over a year, assuming 50 working weeks, the total approaches $1,500. For people who stop on weekends as well, the yearly total climbs even higher. By comparison, making coffee at home costs only a fraction of that price. A bag of ground coffee can produce dozens of cups. Even including milk or sugar, the cost per cup often remains under 20 cents. Over the course of a year, homemade coffee may cost less than $200. The difference between those two habits, buying coffee daily versus making it at home, can easily exceed $1,000 each year. Now imagine that difference continuing year after year. When money is saved instead of spent, it doesn't simply sit still. If invested, It grows over time through compound returns. Even modest investments can expand dramatically when given enough years. $1,000 saved annually may not seem life-changing in the short term, but over decades, the compounding effect can turn that small decision into a surprisingly large amount of money. This example is not really about coffee itself. It represents a broader pattern found throughout modern consumer culture. Companies have learned that turning ordinary routines into premium experiences can generate enormous profit. The coffee shop industry mastered this strategy decades ago by transforming a basic beverage into a lifestyle purchase. The success of that idea was built on a simple insight. People were not just paying for the coffee. They were paying for the environment, the atmosphere, and the feeling of a small daily ritual. Comfortable seating, music, lighting, and personalized drinks created the sense of a third place, somewhere between home and work where people could relax briefly. From a business perspective, the model worked brilliantly. A product that once cost pennies to produce became something customers willingly paid several dollars for. The emotional value attached to the experience made the higher price feel reasonable. The key point, however, is awareness. None of the spending categories discussed throughout this analysis are inherently wrong. Ordering delivery occasionally, watching streaming services, driving a newer car, or enjoying coffee at a cafe can all add genuine comfort to life. The issue arises when these costs become invisible habits rather than conscious decisions. When many small convenience purchases accumulate together, food delivery subscription platforms, fast food, car payments, brand premiums, and daily rituals, they can quietly remove thousands of dollars from household budgets each year. Individually, each purchase seems insignificant. Collectively, they shape financial outcomes over decades. That is why so many people today feel as though they are working harder while financial progress becomes slower. The spending system surrounding modern life has evolved to capture small pieces of income at every step of the day. Once someone begins to recognize these patterns, something interesting happens. Spending decisions start to feel different. The question shifts from, can I afford this right now, to, is this purchase truly worth its long-term cost? And that shift in awareness is often the moment when people begin regaining control over how their money actually flows.